It's Friday, September 26th, 2025, and you are about to go on the markets. Today, we're asking the question, is it time to review your cash? If you're sitting on cash, you've had cash in a money market, you've had cash in short-term treasuries, you've had cash that's been making pretty good interest rates. Let's just leave it. It's cruising. It's 3%, 4%, 5%. It's easy. Or is it changing? Is it time to review it? That and more after this.
The stock market, the economy, your money. What's the latest and what could be next? Find out now with Fermata on the markets. Straightforward financial market updates for the brands of Fermata Advisors, Sonoma Wealth Advisors, Fermata 401k, Fermata Tax, and Fermata Insurance. On the markets starts now.
He is my co-host today, Chris Sipes, CFP, Managing Principal of Sonoma Wealth Advisors and the Fermata family of brands. And Chris, I made a sweeping statement there at the beginning. Maybe not everybody's sitting on cash. I should say, if you're fortunate enough as an investor to be sitting on cash, it's been a pretty good time to have cash, hasn't it?
Yeah, it has, and it's been abnormal because going back to really coming out of the great financial crisis in 2009, when the Fed lowered the short-term interest rates essentially to zero, and they were there for over a decade, people got really used to earning next to nothing in cash. Then we got the inflation spike in 2021 and going into 22. The Fed responded by raising rates dramatically, very quickly. And suddenly people could get decent returns on things like money markets, which, as you remember, Dan, caused all the problems in the banks. Remember when we had a couple of banks blow up because everybody was just taking money out and putting them into money markets and such, and that caused all kinds of problems. But anyway, fast forward to where we're at today, where the Fed is likely starting a new easing cycle. At least that's what the market expectation is. And so the Fed has a lot of influence over the short end of the curve, as we call it, which means the short-term interest rates, which is what flows into the things like money markets, CDs, your kind of traditional cash alternatives, things that people use for safety and not necessarily growth. And so today we're talking about reviewing that strategy, given that the Fed is starting to lower those short-term rates.
So to be clear, when we talk about cash, it's cash in your checking account, which some people have. There are those instruments like a money market or like a short-term treasury where, or depending on, the various custodians will have what's equivalent of a mutual fund, basically, but they call it a money market with a 7-day yield. We're kind of considering those cash, things that are very liquid and recently have been paying you a good interest rate. Can never truly know, but a lot of things are indicating that interest rate environment is shifting, a decreasing environment. And so asking the question, should you be reviewing it right now, at least to look and say, what do I want to do? Correct?
Correct. And if you're getting ready to turn the video off and you're saying to yourself, well, gosh, should I? Well, if you've got a targeted thing that you're saving for, you probably need to just leave it, right? So if you're going to be purchasing a home in the next year and a half, and you say, I need X amount for my down payment, I can't take any risk with it, I need to just, get the best rate that I can on safe money, but I don't want to risk principal. Okay. Look, there's not much you can do to get around that. And same thing with things like emergency funds. You don't want to be taking risk with emergency funds. And so, the money that you've got there for a cushion also might be subject to this. But if you're someone that is sitting on excess cash, going, I don't really want to take any risk with it because, a couple years ago they were earning, 5% annually, and they say, I'm good with 5%. Well, now those rates are creeping down, currently under 4 and probably heading south of that. And so that's what we're talking about, is kind of that excess cash that people were saying, I don't really want to take any risk because I'm okay with, call it 5% in the past or whatever it might have been. That's what's changing.
Chris, our other podcast, It's All Money, you were on one of our early episodes. I think it was our 4th episode. And the headline was, should I put everything in a 5% money market? That was one of our most viewed episodes because that concept sounds really good to a lot of people. Why wouldn't you? Especially like you're sitting there in your online account, if you have an online bank and you're like, if I leave it in this account, it makes 0. And if I put it in this account, it makes money. Golly, I wonder which one I'm going to put it in. So that's kind of what we're talking about today. It is myself, Dano. We're the marketing director, the host, and Chris is joining me today. Darren Blonsky on assignment will return next week. So let's start off in meme land. I love this one because I love the show. It's Always Sunny in Philadelphia. Very funny.
Classic memes. There's probably the top 10 memes of this generation, and this one is in it for sure. Right. It's been used so many times, but we're using it this week because there was the announcement from NVIDIA that they were going to be putting $100 billion into OpenAI, and I guess the thought there is that OpenAI can buy more chips from NVIDIA. So it's kind of interesting. And then you got Oracle also investing in OpenAI. Now, listen, as far as I know, OpenAI's got around like 13 billion in revenue. So obviously people are expecting a massive, massive jump in growth when this thing monetizes someday. But if I'm going to sell you a coffee shop, Dano, and that coffee shop makes 13 billion and I want you to invest 400 billion in it, you're probably not down for that. You shouldn't be.
Right.
You shouldn't be, right? So there's an expected return, here. And I think that we're getting to the part of the story, the narrative, where things are shifting in AI, where it's like it's no longer just these companies are coming up with their own advances and they're largely paying for that out of cash flow. We're going to talk about that this week, where now they're starting to borrow money. They're starting to borrow money, and that money is starting to be invested in one another. So it's sort of like, hey, I'm going to invest $100 billion into your coffee shop so that you turn around and buy a bunch of coffee from me, right? So I don't know. It's too hard for my little
not called
brain.
a bribe. That's not called a bribe, right? That's
too
not.
hard
That's,
for my little
that's an
brain.
investment. Okay, gotcha.
Yeah. So our investing quote of the week comes from Jim Simons at the Millennium Fund, or Medallion. Sorry, I think it was Medallion or Millennium. I don't know why the planets orbit the sun. That doesn't mean I can't predict them. And he was famous for his hedge fund did so well, quantitative only. They only, it wasn't like they were looking at fundamentals on accounts. They were high frequency trading, and he was a mathematician, became trader, and they got so successful that they literally won't even take your money. They gave money back to people, and they wouldn't accept new money because they were like, nope, we're full, no more. So also something to consider, for investors. So sometimes when people come to me and they say, hey, I've got this private investment, it sounds amazing, and they just came to me with it, and I sometimes ask, okay, well, ask yourself, are you the first person to see this, or has it already been, or have others already seen it? Because the thing is about super successful investors like Jim Simons, a lot of times they won't even take your money. So
Right.
Buyer beware.
It was the Medallion Fund, by the way.
Medallion, yes. Thank you. Sorry, late on Fridays. I sometimes the old brain isn't firing the way she used to.
I might have had a Wikipedia assist there, so maybe.
Yeah. So, but I think that quote, sums things up well. When nobody can know exactly what's going to happen, and nobody knows exactly why things do happen, but you can sort of predict where things are going. loosely. And that's what we try to do here is try to understand what the current conditions are, what that's likely to lead to in the coming conditions. And one of the things that we look at is the investor sentiment. This week we've got the AAII sentiment bullish, about exactly the same as it was last week. The bearishness has dropped down a bit. So we're at 41.7 bullishness and 39.2 bearish. So the CNN Fear and Greed Index at 52, which is neutral, down a week ago from 62, which was greed. And Bitcoin, experiencing a little bit of a sell-off this week, is now at 28 fear. So we're getting into the not quite into the, I think they call it extreme fear on that gauge, where you might go, okay,
Ooh,
here we
Bitcoin
go.
109 for Bitcoin.
Yeah, we've got a little sell-off in Bitcoin. So we're at fear versus neutral at 53 last week. Again, Bitcoin tends to be the front end of the risk curve. And so that's why we track it, to know sometimes it moves ahead of other risk assets, especially large cap tech. So it'll be interesting to see if we get a follow on there. So revisiting the slide.
Hold on a second.
Go ahead.
Bitcoin down 5% this past week, and Darren is out for this episode. Coincidence? I
think
mean,
not.
I think he didn't want to hear the music. He's too many victory laps. He's taking a break from his victory laps.
Careful now. We're going to get Teams messages rapid fire here in a minute.
I am driving and listening to the show. You need to stop. Yeah, here it is. We love it. We love it. We love you, Darren.
So revisiting our conditions slide from Mike Philibrick at Resolve last week, where we show the different conditions and how different asset classes can perform based on the economic environment that you're in. And so half the time it's difficult to tell where you're at, right? But if we had to guess right now, if we look at the zone where gold is doing the best, where commodities are doing well, bonds are doing well, and equities, kind of everything is positive to different extents, but gold is doing the best, I think you would have to say we're falling into the inflationary boom area of this chart. Okay, because gold, while U.S. equities have done well, nowhere near as well as gold this year. While bonds have done well, nowhere near as well as gold. The one area where that may not have fully happened yet is the commodities space. We've looked at things like oil and even copper. There's been several of the commodities we've looked at where you just really it's not been. So that would be the only thing where you say maybe not. But otherwise, it seems like the inflationary boom. Now, also, given that the Fed has started to lower rates, and yet we are seeing rates going up from the market, that would also tell me the market's expecting more inflation. And so I kind of lean towards that top right box here of an inflationary boom, that the powers that be are going to run it hot and try to outpace the debt, especially in the United States, through inflation and nominal growth. So we'll see if that ends up being the case. Who knows? But that would be the best guess for today. Now, if we look at the other area where gold tends to do well and tends to outperform the other asset classes, that would have to be inflationary stagnation, in which case bonds tend to do horrible, and so do equities tend to struggle in that environment. So we're not seeing that, at least this year. If you look at deflationary bust, that's something more akin to the great financial crisis. Now, bonds do great in that type of scenario, but equities just get destroyed in that type of environment, and we definitely have not seen that this year. So kind of process of elimination here, it seems like that top right corner And it never fits fully in the box, guys. It's going to be a moving target. It's what's in a spectrum. There's more art than science here. But I would say we're kind of tilted towards that top right box.
So potentially even more inflation, which might be one of the first things to consider when we're talking about review your cash.
Correct. Now this year in the S&P, this is from Ryan Dietrich, we talk about this a lot, how, look, there's average returns, and people love to talk about average returns in especially stocks as an asset class. However, this year being another year like that, you hardly ever get average returns. So Ryan Dietrich says here, when the S&P 500 is higher for the year, big gains are perfectly normal. Now, he doesn't put in also the returns when they're down are usually pretty big too, which you see here. When the S&P is lower, that it looks like the average is 13.9, down by 13.9. But when it's up about 19. So the variation is very large whenever you're in one asset class exclusively. And so this year has been sort of a normal year in that standpoint, where typically when you're having a good year, you're having a very good year. Hardly ever see the average.
And you managed to sneak in a slide that starts in 1928, Chris.
That's right. So we got the core PCE this week, and that came in as expected, and so the market rallied today. That news came out today. Now, why is the core PCE important? Because supposedly that's one of the main inputs for the Fed, and they track that closely for whether or not they are going to lower rates. So I guess the logic there is, it comes in as expected, the Fed can still lower rates. If it comes in above expectations, the Fed's got to pump the brakes and not lower those rates. Now you can see the overlay of the CPI, the Consumer Price Index here, year over year, kind of tracking along with that. The PCE, the core PCE, is a less noisy version. However, when it's not moving a lot, like currently, these tend to move kind of in lockstep. And so I think what you'll notice here, though, is the downward trend that we saw, call it mid 2022 coming into 23, has ended. So we are at best kind of in a sideways trend here when it comes to inflation. And so, to your point, Dan, this is where, not only are the short-term rates lowering for those with cash, but also you've got inflation sticky, right? We've got, call it, close to 3% inflation year over year, and that is going to be eating at your buying power. So we talk about this a lot, where there is no such thing as a riskless asset. Every asset class has risk. Sometimes it's apparent and sometimes it's not. Cash is one where it's really tricky because it doesn't feel risky because the principal doesn't change. However, it is risky when you look at it on a buying power basis, and especially over a long period of time, that can be an issue. Now,
Chris, I want to stop on that point for a second, because that was something before I worked in the business and then now in the business. That point right there, the risk of cash, was something I could not wrap my brain around because I had not lived long enough. So you have this really simple structure in your brain from when you're a kid. You make money however you make money, mowing lawns or, baby teeth or whatever. You go to the bank. The bank is safe. You give them the bank, the number shows up in your account. Boom, there's my number. If I want to get that bigger, I have to make more money and build that number up. And that's the way that it works. And it's safe in there, right? So that's like reptilian brain understanding of like your cash. But the reality is, over time, I've lived long enough to see the In-N-Out double meal go from literally $5 flat to over 10 now in not that long. And if you kept that cash in the bank, you're getting fewer double doubles, which is clearly the financial goal of most people. So
That's right.
That's a joke. So, but my point is inflation is real. Price changes are real. And just sitting there and being like, it's going to be safe in cash, you have to play their game.
Yeah. Yeah. And in some ways, the COVID inflation was a gift for those that wanted to get educated on inflation, because the tricky thing when it's 3%, when it's 2%, when it's 1.5%, like it's less noticeable, right? COVID, coming out of that, it was so noticeable that everybody got angry about it, right? Because you're like, oh, I can't buy a car, I can't go to the grocery store, I can't buy a house. Everything is so much more expensive, and so you immediately understand, oh, this is how inflation works.
Yeah.
When it's a little bit at a time,
right?
That's where it's less noticeable, right? It's boiling the frog. And so back to the train of thought here. What's the market telling us? What's the market telling us? Well, it's only been, since the 17th, so we've only had like a little over a week. But look what has happened to short and long-term interest rates since the Fed cut 0.25% on the 17th. You've got all the interest rates, and these interest rates are set by the market, meaning investors all over the world, setting the price through supply and demand. And the market is saying, hey, we're not lowering rates right now. And that could be for a myriad of reasons. A lot of times you see rates going up because growth expectations are going up. So that could be it. But it could also be inflation expectations. And in order to understand this, think of yourself as a bondholder. So think of someone that is going to buy a bond. You want to get a rate of return, and a big part of that rate of return is you're going to have to say, I need to earn more than inflation in order for me to put my money at risk, right? And so when you're buying a 10-year, when you're buying a 30-year, that's a really long projection, but that's what these buyers are doing, is looking at, hey, I need to have some cushion to make sure that I can exceed inflation. And so if investors are saying, okay, maybe inflation's going up, they're going to require a higher rate of return in order to make those investments. So it could be too easy to tell, or too early to tell. This could be just noise, but at least so far across the curve, interest rates have gone up, despite the fact that the Fed has started to lower rates. So again, going back to the point of this, your cash, your money market rates, et cetera, going down because the super short term rates are going down. However, the rest of the world is expecting a higher inflation rate out there, and so those rates are going up. Hopefully that makes sense, Dan.
I think it does, and it's a perfect example of the market is the market. The market is a beast unto itself, and the Fed can do a lot. The president can do a lot, but they aren't actually in control of it. Correct.
And so, how do those higher interest rates on things like treasuries flow through to the rest of the real world? Well, here's a perfect example with 30-year mortgages. Also, since the 17th, you can see that those have gone up by 0.64%. And if you say to yourself, it's not that much. Well, yeah, based on a 30-year rate of maybe call it 6.3, somewhere in there. 0.64 that's a big move relative to that mortgage rate. So this is where it will come into, how does it flow through to the real world?
Yeah, and for people who've been sitting there, they bought at 7 or some ungodly number 9. They've been dying for this rate cut, and then here it comes, and then to see it go up, that's one of the reasons why we preach, making sure whatever you get into, whether it's real estate or whether it's investment or whatever, making sure that you can keep your head above water no matter what. Because if you sit there and plan your life, hinge your life on something happening with the federal government, Chris, I'm going to tell you something. You're going to be sorely disappointed many times. I try not to need the Fed or the federal government to do much for me.
Yeah. Yeah. I don't know if you're able to remove our little logo there, Dan, just temporarily, so people, if they look at this, they can see the key takeaways. Okay, so we've got inflation erodes purchasing power. So going back to the concept of this over time, this is the erosion from 1983. So, if you put $10 in the bank and just let it sit there since 1983, that's worth about $3 in terms of purchasing power today. So again, there's risk everywhere. You cannot ever look at any type of investment and say it's no risk. There is a risk. You just need to know what it is, right? And you need to know balancing those risks. Because even cash has a risk, and its risk is losing purchasing power over time. Hence the need to take risk in order to try to keep up with inflation. Now, we've got that combined with the fact that money market funds are at an all-time high. There's over $7 trillion in money market funds in the U.S., and so there's a sizable amount, and for good reason. Like we talked about, I don't remember exactly what date you said that it was when it was 5%, but that's not that long ago. But in terms of the Fed changes, that is accumulating. And so now we've got the Fed funds rate at between 4 and 4.25. That's their target rate, and they're expected to drop again two more times this year for a total of another 0.5%. So then we'd be down in the 3.5 to 3.75. So that's going to have an effect on these rates. So again, if you don't need it for an emergency fund, if you don't need it for some specific purchase coming up, if you don't have debt to pay off, that's another one. We're not keen on people carrying any type of consumer debt and investing at the same time. That doesn't make sense, right? You got money leaking out one pocket while you're trying to stuff it into the other. It's probably going to be leaking out way faster in that debt out of that debt pocket. So, but outside of those reasons, look, you got to think about getting invested in risk assets to keep up with that inflation over time. Well, I think Buffett has some sort of saying that's like, there's not much you can bank on in life, but he says, death, taxes, and I think he said the third one was governments will inflate.
That's for sure. That's for sure. So let's. I was thinking about it at the end, but just in case people are with us so far, when you're saying review your cash, we're saying that this episode, we're giving some of the reasons why. What would the functional next steps be for one of our clients or an investor? Sit down with your advisor and look at the cash, and then do some planning around, hey, I want to buy X, Y, and Z. I need to pay off these things. Whatever's left over, how badly do I need liquidity in it? And should I put it in something else like mutual fund, bonds, etc.? Is that what you're saying?
Yes. Yeah, I think that would be smart. So at least look at it yourself, right? And if you can eyeball it and you're like, yeah, that makes sense. That's my 3 to 6 months or however long that I've got for my emergency fund. That's roughly right. And or I need X amount of dollars for my down payment on the house next year. So yep, that looks good. But if you're like, man, I parked it there because I was just so afraid of, this, that, or the other thing, and I thought, I'm too afraid to put the money into anything else, but I can get, formerly 5% in a money market. I'll just park it there. That's good enough. I'm cool with that. That is the situation that you should go. I need to get with my advisor, see what the other options are, look at the pros and cons, and see if we should make some changes. Okay, so I think this slide got a little stretched. It looks like maybe we kind of cut off the top of it. Apologies there, but this is the top 50 versus the bottom 50. Bottom 450 of the S&P 500, and this is from Jury and Timmer. I'm not sure what I did to the slide sizing there. As I was mentioning to you, Dan, I've been having a lot of scaling issues lately with Microsoft. But anyway, Jury and Timmer at Fidelity, he's showing the top 50 versus the bottom 50. And he says it's worth remembering that while the top-heavy concentration during the late 90s was quickly reversed in the early 2000s, during the 1950s and 1960s, the market remained top-heavy for many years before excessive valuations finally took their toll. This could take some time. And that's what we've talked about in the past where, hey, you've got these valuation metrics, you've got this concentration metrics, all of these things, increase the risk of the S&P on the surface. And you can't use it as a timing tool, right? You can't expect to use it as a timing tool. And here, this chart, shows that because really for most of the 50s and 60s, the S&P was also highly concentrated. Then at the end of the 60s, the valuations got to a point where the Nifty 50 just made no sense anymore in terms of forward-looking returns. And so that changed over the period in the 70s. So you can see we're elevated relative to history in terms of the concentration. However, like Jurian says, this could go on for a while. We don't know for sure.
So this graph is showing what percentage of the market is the top 50 companies and what percentage is the bottom 450. Is that what I'm looking at?
That's right. That's right. So now, the top 50 is 63% versus the bottom 450 companies in the S&P would be 37% of the S&P.
Okay. There we go. Next.
Okay. So like we mentioned at the beginning of the video, things are changing kind of in the AI world with the introduction of debt to the story. And this is from Mike Siccardi, or I guess it's JP Morgan, but by way of Mike Siccardi, just talking about the debt to equity ratios. So the amount of debt the company has versus its equity, just like it says, of direct AI stocks. Now this is a number that changes, right? But you look at Oracle, it's got roughly five times the debt to its equity. So you're getting some leverage in there. And even Apple, while it's not quite at 2 like it was in this chart, I think as of today it's about 1.5. It's not as bootstrapped. Now, on the plus side, look at companies like Nvidia, Google, Palantir, some of the real stocks that have ramped. Those have very low debt to equity ratios, so that's on the plus side, right? But debt leverage is one of those things that can increase returns, but it can also increase losses. So it amplifies whatever's happening. And usually most financially related issues are somehow related to excess debt in one way or another. So it's something to keep an eye on. I don't think it may be anything to panic about at this point, but definitely something to keep an eye on as we flow through this narrative, cycle with the AI stocks.
So of all the players right now, this is who's gambling the most.
This is just who's using other people's money the most, and
that's what I mean. That's what I mean. They're on the hook. They're on the hook to somebody else.
Yeah, exactly. So small cap earnings yet to recover. I thought this was really interesting, and this clearly explains why small caps have struggled, because we've pointed that out here recently. They've been doing great, hit an all-time high recently. That would also go for our thesis around the inflationary boom time. Small caps tend to benefit during boom times. So we've seen an upturn in those earnings of small caps. However, look at the drop off that we saw in 22 of those small cap earnings versus the large cap. And that's why the large caps have outperformed so well, because over time it's earnings that matter. It's earnings that's what, the market follows in anticipation of earnings. And I thought this was really interesting. This only goes back to 2000, so it's only 25 years. But I would love to know the other times in history where these two earnings drawdowns have separated as much as they did during this cycle since the 2021 cycle. We talked a lot about how really 2022, I'm surprised they never called a recession because most asset markets got destroyed in 2022 and 23. And there was just a few companies in the S&P that really held everything up. And that's very clearly shown here. And it looks fairly abnormal, at least for this time period. I wonder if you could go back further, what that would look like. All right, so this is from Kevin Gordon at Schwab. Kind of a lot going on this chart, but what you're looking at here is the white line being the Fed funds rate, okay? And then the blue line is the forward earnings on the S&P, the forward price to earnings ratio. And what Kevin says here is the S&P 500's forward price to earnings is at the same level today as it was in January of 2021. Today, the effective funds rate is 4.09. In January 2021, it was 0.09. So I clearly remember at that time, Dan, that stocks were so highly priced. And one of the narratives for the reason why they were so highly priced was because interest rates were so low. Therefore, there was such a small discount rate in the market that it justified higher valuations. I clearly remember a lot of smart people saying that, and it makes sense. It's like, oh, yeah, if there's a lower discount rate, of course, stocks can be more expensive. The expected return on stocks would be lower because there's no hurdle to get over. Now that narrative obviously doesn't make any sense. We've got interest rates much higher, stocks still at the same, really the same valuation metric, forward price to earnings. And so just another one of those things in the investing world. It's like, sure, that makes sense, and it probably applies sometimes, and then sometimes it doesn't.
Until we feel like it doesn't, and then it's like, well, not every time. Like, it's counterintuitive.
Yeah. Yes. Yeah. Exactly. Now, but going back to Jim Simon's quote of like, "Hey, I don't know why the planets do what they do, but I can sort of predict where they're going." We'll see. But with forward earnings, price to earnings ratios as high as they are today, historically, that said predictable that we're going to get lower earnings in stocks moving forward. So that would be the prediction around, hey, where are these asset classes going? Where are the planets going? Don't know why they're at where they're at now or why they do what they do, but mean reversion would say valuations are high now. You should expect lower returns in stocks moving forward. All right, so let's talk the asset classes. No sign of trouble yet. When you look at the technicals in the S&P, we've got the 50-day simple moving average in gray, which is kind of a more sensitive trend line. And then we've got the 200-day simple moving average in green, and that is a less sensitive trend line. And you can see that the S&P is comfortably above both of those indicators. The trend is obviously up. Looks pretty strong as of today. No signs of weakness. We've got really the same picture in foreign stocks, foreign developed, as represented by the EFA index here. Again, comfortably above the 50-day moving average. We're in an uptrend in foreign stocks as well. Foreign stocks, again, doing great this year so far, both on the developed and the emerging markets. Emerging markets here, you can see strength, uptrend in the 50-day moving average. Price is comfortably above that 50-day moving average. So stocks kind of globally right now, Dan, looking pretty strong. No signs of weakness in the technicals at this point. So if you're just following price as the truth, sunny skies out there right now. No clouds on the horizon that we can see. All right. Now we take a look at some of the small cap stocks here as represented by the Russell 2000. Again, looking strong. You'll see here these are a lot more volatile than the large cap stocks. You can kind of tell that through how squiggly these squiggly lines are, and even how rapidly the changes happen in the 50-day and 200-day moving averages. But you've got the 50-day moving average moving up. We've got that golden cross back earlier in the year where the 50-day crossed the 200-day on the upside. It looks like no signs of weakness there yet. And the small caps are catching up, not quite to where the large caps as represented by the S&P are for the year, but gaining ground as the months go by. And looking strong. Same thing with the mid caps. Again, you got the 50-day above the 200-day, so we're in an uptrend, not approaching that 50-day on a technical basis. So mid caps, so kind of the medium-sized U.S.-based companies, also looking strong. So bonds. Let's see, we got the emerging markets there. Here's the bond market as represented by the AG. So this would be the U.S. bond market, the aggregate bonds, looking strong. So bonds are having a positive year price wise for the first time in what probably feels like an eternity to investors. So not only are you getting that decent coupon from the interest rates moving up over the last few years, but also with interest rates, kind of staying at least flat and trending down over the last year, despite what they've done since the Fed started cutting. We've got some fairly good momentum going in the bond market, as well as measured by the AG. Now, if we take a look at Bitcoin as represented by IBIT here, which is probably the most traded, I would guess, ETF on Bitcoin. A little bit of technical damage this week. Like we said, Dan, Bitcoin's price was hovering down 109, so we've broken down under the 50-day moving average. You can see that the price has struggled to stay above that 50-day moving average here recently since, call it the end of August going into September. And so a little bit of technical damage done there. I don't think you can't say that it's confirmed a downtrend yet, because that 50-day moving average is still, pretty parallel to the 200, maybe curling over a bit, but we don't have a downtrend, confirmed or anything. And Bitcoin's very, very volatile, so you could watch this on Monday and go, what were those guys talking about?
Right.
They were way off.
Yeah.
But that's where we're at today. So a little technical damage there. Gold, the classic Bitcoin classic, having a heck of a year. Again, when we look in that inflationary boom thesis, gosh, gold's got to be telling us something. It just feels like it goes up every day. I mean, that's not true, of course. It goes down some. But man, a lot of strength out of gold this year. Technically, looking strong. If anything, technically, it's kind of getting a ways away from its 50-day moving average, which usually when you get to see some space, you get some stretch, you get overbought conditions is what they call it, which sounds kind of funny, but it's kind of measuring the panic with which people are buying, and that fervor can die off a bit. And so I wouldn't be surprised to see a little pullback here in gold now that it's just been ripping higher through the month of September again. But
we
overall,
I feel like we said that 3 times this year.
Yeah.
I mean,
yeah.
we've just been like, okay, now. No, but now for real. And it's just like higher and higher and higher. And one of our earlier episodes of this show on the markets earlier this year, Chris, you and I were talking about how gold has no PR machine behind it. And so it's just not one of those things that you see headlines about. Not that headlines dictate our investing, but it contributes to the vibes in the room. I spend a lot of time on news feeds, Chris, and some of my news feeds include financial information. I get nothing on gold. I mean, the average person is talking about crypto before they're talking about gold, and gold is just continues to be on a tear. And so it's interesting. It's just very interesting that one of the reasons I think that gold doesn't get a lot of headline run, which is that it seems like kind of hokey. Like it's like, oh, we've all seen gold commercials. That exact reason, I think, is one of the reasons why it is on a run, is because it's almost like a base level, like very primitive, feels safer, so it's kind of interesting.
Yeah, that's very true, Dan. I haven't looked at it recently, but earlier in the year, I think, or maybe late last year, despite the huge run in gold, there was actually negative flows from the ETFs, meaning that people were taking money out of the ETFs, like the average person. That tends to be a good sign when something is doing very well and nobody likes it. You're not hearing about it everywhere you go. People aren't asking about it. Like you said, nobody's really paying any attention, and the price is still going up. Oof, that's usually a good sign. I don't know what that looks like today. I'm assuming that it's caught a little bit more attention than it was, say, a year ago. But Mike's comments on the fact that central banks have been buying it as an alternative to treasuries. After the sanctioning of the Russian assets and seizure of the Russian assets, I think that makes a lot of sense. But also, if interest rates are telling a story around inflation as well, that could be another reason why people are preferring gold as another asset class outside their equities as an alternative. So gold's definitely having a moment this year.
So we thank you for checking out the show today. Darren will return next week. In summary, let's just review, since the title of the episode is literally review. There's a number of economic and monetary factors that are indicating interest rates that you've been getting on things like money market accounts may be shifting. Who really knows? You can never truly know until after the fact, but there's an environment where that could definitely be more possible than it has been previously recently. So our suggestion is to at least review your cash. And Chris, for someone who is hearing that call right now, what should they do? Let's say that again. What should they do?
Well, look at it and say to yourself, do I need this money for emergency fund purposes? Call it 3 to 6 months of your expenses, or do I need this money for a specific purchase that I know I'm going to need to make in the next year and a half? And if you look at that number and say, no, I have way more than that, and I don't have any say high interest debt or consumer type debt to pay off, then I would reach out to your advisor and take a look at some other options, so that you have less of a probability of getting eaten up by inflation over the long run.
And if we are your advisor, we hope that's the case. You should know at this point how to get in touch with your advisor. SonomaWealth.com is one way you can get to us if you're just totally slipping your mind, or you can call our front desk. But just call or email your advisor to get a conversation started. If we're not your advisor, perhaps you're checking out the show for the first time today, or you've been watching us for a long time, and you're like, you know what, today's the day. Fine, I'm going to do it. Those two same methods. You can call our front desk, 707-938-7414, or check out our website, sonomawealth.com, and you can learn about our holistic approach to finance. We are Sonoma Wealth Advisors and the Fermata family of brands. Thank you for checking out our show on the markets. We love doing it. And Chris, thank you for a great show, and we'll see you all next week.
You're up to date with Fermata on the markets. Learn about how the Fermata Advisors family of brands can help your family and business in finance. Sonoma Wealth Advisors, a comprehensive, holistic finance solution offering financial planning, asset management, and tax planning. Take our free wealth analysis now at sonomawealth.com. Fermata 401k, business retirement solutions for small and large companies with a fiduciary commitment. Learn more at fermata401k.com. Fermata Tax, personalized tax services for yourself, your family, or your business with an emphasis on efficiency. Find out how at fermatatax.com. Fermata Insurance. Appropriate insurance is an important part of a financial plan. Find out what coverages you may be missing at fermatainsurance.com. If you haven't already, like and subscribe to Fermata on the Markets on YouTube, Spotify, and Apple Podcasts. Fermata on the Markets features human hosts, editors, and voiceover talent. Music by Dr. Delight on Soundstripe, voiceover by Joan Alloway Nash. Thank you for listening to the very end. We appreciate diligent viewers and listeners. Fermata Advisors LLC is registered as an investment advisor with the SEC and only transacts business in states where it is properly registered or is excluded or exempt from registration requirements. This content was produced by Fermata Advisors LLC, DBA Sonoma Wealth Advisors, DBA Fermata 401k, DBA Fermata Tax, DBA Fermata Insurance. The opinions expressed by Fermata Advisors LLC on this show are their own. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Viewers and listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance.